I'm David Bank from ImpactAlpha. I'm delighted to be here with Alex Flachsbart and Patrick Mullen. Alex is with Opportunity Alabama, and Patrick is with Arctaris Impact
Investors.
Investors.
Yep.
Got that right. Well, we're going to talk about opportunity zones, and in particular, how to mobilize capital for underserved rural areas. But let's just set a little bit of context about opportunity zones. They've gotten a lot of attention in the last few years. You both have been practitioners in the field. I don't know which one of you wants to take the first stab at just giving us the super brief explanation of what it is and how it can be used.
I'll take it this time. So Opportunity Zones is a tool that came out of the Tax Cuts and Jobs Act of 2017 that was intended to, be a new pool of capital for investment into low-income places across the U.S. Every governor got to pick up to 25% of their low-income census tracts as opportunity zones in the spring of 2018. Once those zones were set, they were set in stone. And there's obviously been some discussion over the years about how the zones got picked, and each state did it differently. And that is its own whole ball of wax that we could have a whole conversation about. But the incentive itself is designed to provide substantial benefits to people that have capital gains and want to take those capital gains and reinvest those capital gains into these certain designated low-income areas across the U.S. The structure of the incentive is such that it substantially rewards investors that are putting money into assets that will appreciate over the course of a 10-year period. I mean, again, the way it works, if I've got a dollar of capital gain today and I put it into an opportunity fund that goes and invests in these targeted areas, I will get a temporary tax holiday, right? Between now and 2026. But if I've invested really well and that dollar becomes $3, $4, 10 years from now, when I liquidate that investment, I'm not paying any capital gains tax at all on the appreciation, right? So it's inherently an incentive that's designed to reward appreciation, right? Which is really interesting for this rural conversation, because it's a lot harder to see that in rural places, in most rural places we work.
Okay, you've dived in, and as I said, this gets a lot of nuance to this,
Right.
and it gets very wonky very quickly. But let's just get this out of the way right at the top. There's been a lot of pushback that opportunity zones have not fulfilled necessarily their original intent. There have been lots of examples that have gotten some attention of places that may or not have been that underserved in the first place, or that opportunity zones are accelerating gentrification, all kinds of criticisms that have happened. Warranted or unwarranted?
I mean, there's certainly some bad examples that are warranted for some of those criticisms that I think we've seen. And I think you have to acknowledge that in any sort of incentive that ties to private capital, there's always going to be bad actors that kind of float to that. But for the most part, I think one of the things that we've seen is that if you go back to the true intent of opportunity zones, they were really kind of sold as this way to democratize investing in businesses, right? Take this idea of Silicon Valley and bring it to other parts of the country that didn't have access to capital before. But if you go back to the way the incentive works, you need to hold these assets for really a minimum of 10 years. And so it really put a little bit of fear in the investment community. Could we do that in a business? What happens if the business moves? There's a whole bunch of variability. And so the vast majority of the capital that's been invested to date has been primarily in real estate, which I think is one of the criticisms you hear. Hey, why not more operating businesses?
Mm-hmm.
But I think we're beginning to see the tide turn a little bit in that with funds, like Arctaris that are investing in businesses. We're seeing governments kind of step up to add additional incentives. Philanthropy's playing a role in trying to help drive the capital to go to some of those areas. And one of the things that I think, Alex and I agree on is that opportunity zones, if you want to look at some of the unintended benefits that are really massive, they've served as kind of this first domino to fall in how we're repurposing the argument around getting private capital into underserved areas, both urban and rural. And it's really led to an unprecedented amount of public money going into those areas, new incentives, and conversations that just would have never happened between investors in these communities. So there's been, in my opinion, much more of a net positive, but I think the bad actors that are out there have hogged a little bit more of the headlines, and it's created a dynamic that's harder to talk about.
Indeed. Okay, so now that we've laid that baseline down, let's find out who you two are and what you've been doing in this context. So, Alex, maybe you take the first cut and tell us about Opportunity Alabama.
Sure. So Opportunity Alabama is a 4-year-old 501c3 organization that came out really as when OZs did in the fall of 2018 as a statewide response strategy to this brand new tool that no one knew what it was, no one knew how to use it, no one knew how to galvanize momentum around it. So coalition of the state's largest bank, the state's largest insurance company, the state's largest utility, and other private philanthropists across the state said, look, Alabama's done a historically bad job of mobilizing capital around low-income places. Here's this new excuse for us to bring communities, projects, investors, those three groups together to start talking about what it means to authentically invest and to use this new tool as the excuse and the incentive to do so. And we did. So we created this ecosystem kind of from scratch that helped to drive 350 million plus worth of deal flow into opportunity zones across the state over the course of basically from when we were founded until COVID. When COVID hit, it was so interesting for us because so much of our model was me and my team driving to literally every one of Alabama's 67 counties, each of which had an opportunity zone, and doing so much of the work that that Patrick did in Utah of building trust, building relationships, right, and building kind of the through educational events, through seminars, through in-person events. And COVID happens, and it's very hard to do that anymore. So it made us reflect on the organization as to how can we be delivering services to the communities where we work on a much more comprehensive basis. So out of COVID, we said, look, we're going to have a nonprofit side that will continue to build that ecosystem, but that will take interesting examples that we see from communities of projects that if there wasn't a little bit of additional assistance, if there wasn't additional technical assistance, if there wasn't someone to do demand studies, build pro forma, help to build out a pre-development schedule and a budget for a project, probably wouldn't go anywhere. But if they had that technical assistance, it could be totally catalytic for the community. So our nonprofit side does that now. Really, it works directly with the communities we've built these relationships with to help on projects. And at the end of the day, sometimes those projects are in opportunity zones, sometimes they're not. It's where the community tells us they have a critical need and where we're able to build a coalition around getting a project done. At the same time, we said, look, this tool is so interesting and exciting and powerful that at the end of the day, we could probably raise some capital ourselves around this, given the depth of relationships we have. So we set up a for-profit subsidiary that we've built into a private equity real estate fund that focuses exclusively on Alabama and uses our depth of knowledge about communities and what's happening in those communities to identify assets that are going to be double bottom line investments for our LPs that are going to provide an attractive rate of return, but also meaningful impact in the communities that we serve. So, at the end of the day, we see opportunity zones provide kind of the impetus for this new mousetrap that exists to serve and can now kind of serve in perpetuity because the way we have the organization structured, Alabama's low-income places and continuing to kind of generate that feedback loop of new and interesting projects that are going to matter and be catalytic for those low-income places.
And just to make it real, just give us a smattering of what the kind of projects you're backing are.
Oh, man. How long do we have? So we are, let's talk about both sides of the house, right? So on the nonprofit side, we've provided technical assistance and connections to capital to, let's say, a grocery store in Livingston, Alabama that's been desperately needed for the better part of a decade, where we were able to come in, work with the community to identify the need, build out all the materials I just told you about, the demand assessment, bring in an operator, and actually work with the local CDFI to provide the capital, right? No opportunity zone investment, but it was what the community needed, and it's what we were able to help mobilize our network to do. Selma, where we were able to work with a national opportunity fund, in this case, to make an opportunity zone investment into a hotel, the St. James Hotel, that is now open and providing, an anchor for redevelopment along the entirety of Selma's waterfront. We now, as a follow-on to that, have out of the nonprofit side teed up 2 more projects on Water Avenue. So it's projects like that, and then obviously on the for-profit side, we're heavily invested in workforce housing, particularly in places like Birmingham that desperately need it. We're invested in an industrial project in Macon County, Alabama, for example. It sits directly between the 2 largest Korean manufacturing operations in the U.S. And will be a fabulous home for a second, third-tier supplier within that network, but that is in a county that's one of the poorest in the state, and that was absolutely an OZ investment out of an OZ fund.
Now, Patrick, you wear 2 hats. You were telling me about both as an opportunity zone investor and also putting together a kind of ecosystem of your own in Utah. So tell us about that.
Yeah. So actually, not all that dissimilar from Alex. If we go back to kind of early 2018 when the opportunity zones were being passed, I had just left a firm I was with for almost a decade, as Sorensen Impact, who's obviously now hosting us at this conference. And Jim Sorensen, the founder of that organization, was very prominently involved in the passage of opportunity zones. He was very influential in working to kind of help them become a tool to help underserved areas. And I began working with Arctaris, who obviously now is an opportunity zone investor ourselves, but I got a phone call from my friends in Utah, from the governor's office and from Jim and from others who said, look, very similar to Alabama and other states across the country, we need help because a lot of our rural communities are calling the governor's office saying, how does this incentive work and does the money show up tomorrow? And investors were simultaneously calling and saying, hey, you guys must be ahead of the curve. You have this great kind of impact investor in the Sorensen Center in the state. What is your strategy for opportunity zones? And I think we were all collectively caught a little bit flat-footed. And so what we did in Utah to kind of help address that problem is we put together an organization that really was comprised of 3 pillars. The most important of which were these communities themselves. So we brought in the statewide Association of Counties, whose leadership is made up of local elected officials in all 29 of Utah's counties. We brought in Sorensen Impact as sort of the impact investment nationwide experts who had this kind of network. And thankfully, the state governor's office funded the entire thing. So with all 3 involved, we sort of put this coalition that I was lucky enough to sort of spearhead, and we went into these rural communities and began to really try and offer technical assistance, really be a voice. I think one of the things Alex and I spoke about on a panel we were on earlier today is a lot of year one was just listening and showing up, right? And being in these communities and understanding what it is that they wanted to do. But as we got kind of further into it, what we began to see was, hey, these problems and these issues may not all be the exact same in each of these counties, but there's broader themes that can be replicated, right? There was a clear barrier to the types of language that investors were speaking and folks actually living in these communities were. And so we thought, could we do something like a playbook that helps sort of demystify the opportunity zone and private capital investment process and lays out best practices for how you build a community framework, how you sort of go about a community needs assessment, and really sort of puts out, best practices and lessons learned from kind of the 2 years that we had been doing it. And on top of that, you mentioned the other hat that I wear. I was very lucky to kind of have a unique perspective that simultaneous to sort of doing the work on the ground in Utah, I was also working with Arctaris, which is a nationwide investor in underserved areas and opportunity zones, including in Alabama and in Utah, and really beginning to see kind of real-time examples coming out. So as we wrote this playbook, as we engaged with stakeholders in our community, we not only sort of were taking it on the ground from people trying to solve the problem, we were coming from the other side and saying, well, here's what other investors are doing in other places. And it really was a good match to kind of help communities come to best outcomes.
Well, so one of the things is that opportunity zones, I think, have had a reputation as being mostly an urban, low-income, inner-city sort of solution. And you both were taking it out and saying that there are rural opportunities and rural opportunity zones that might have different needs or different dynamics that you'd have to. So what's different in rural areas than in urban areas?
So I mean, I think the first and most interesting, discussion point around rural opportunity zones is where we started this, which is you don't normally see as much appreciation on any particular piece of property. If you're going to pick one in rural Alabama versus one in Birmingham or Huntsville, odds are you're going to see more appreciation in Huntsville and Birmingham, all other things being equal, than you will in a rural spot. So the question is, how can you use OZs as an excuse to facilitate local vesting, to get people who just cut timber and had a gain event, right? And wouldn't otherwise have, maybe they'd put it in their 401k, maybe they'd, go invest in, maybe they'd go call their financial advisor if they have one. But at the end of the day, OZs give you an excuse for engaging, if there is an ecosystem in place locally, with whatever that ecosystem is, to potentially take some of those gains and reinvest them into the community. So we've seen that in multiple communities in the state. We've also, again, seen OZs as one of the most effective rallying points for projects that need complex capital stacking. So most of the projects that we work on in rural places are going to be some combination of historic tax credits, new markets tax credits, opportunity zones, USDA funding. I mean, it's just, you could name the alphabet soup of federal agencies that are needed to get one of these catalytic placemaking projects done. And of all the things in that capital stack, weirdly enough, OZ equity is almost always the most flexible piece of it, because it's equity. Because, I mean, say what you will about Treasury and the regs, but they, at the end of the day, are very flexible. And that's, I think, one of the net positives of OZs. So I think, because of the tool's flexibility, because of its unique ability to draw in people, particularly in rural places that have had gains and are using that kind of as an excuse for doing something they may have otherwise been predisposed towards doing, but now have more of a nudge to go do, even though there's not as much ramp headway for appreciation.
So this is local investors in local projects.
Right.
Yeah, yeah.
And I would add, I think very similar, it's sort of a question of how much you have to de-risk a deal for it to be investable, whether it's local investors or national investors, right? And anytime you're in a rural area, that level of de-risking is almost always much higher than it is in an urban area because you have so many additional variables that you have to solve for, right? If it's, hey, help us build a new manufacturing facility because we want to bring new jobs to town, you say, well, great. Where are those new jobs? Are there homes for them to live in? What about the education system? Can it take it on? Because it might even be at capacity. And so you sort of create this chicken and egg like problem that you then have to bring in additional types of capital to solve, whether it's state government, federal government, philanthropy. And all of a sudden you took a deal that when it started was, how do we build a manufacturing facility? And it's become, well, how do we build the housing we need for that? And how do we deal with 8 different types of grants? And how does this kind of look like bringing in the investors? And that's not an inherently bad thing, but it is an inherently hard thing. And I think a lot of times capital doesn't want to flow that way. And what we're trying to collectively do, I think between all of our organizations, is really flip that paradigm and bring in kind of ways to make it easier and unlock capital that previously was just not looking at these types of areas.
So you've got this Rural Opportunity Zone playbook that you guys have just put out recently from Sorensen and Arctaris, I think, helped produce it.
Well, technically, so the playbook was published by Sorensen and the Utah Association of Counties jointly. So it was an economic development administration grant focused wholly on Utah, but to be beamed out more nationally to funds like Arctaris and the communities we work in.
I see. So what are some of the plays in the playbook that we haven't touched on yet?
Well, I would first encourage everyone to look at the playbook. I think SOCAP links to it, but it lives on Sorensen Impact's website. It's a fantastic tool that we would encourage all communities to look at. But really, the playbook starts sort of at the community level, right? Before we get into any sort of here's case studies, here's technical ways you can kind of structure investments, it really goes into how do you go about conducting a community needs assessment? Who are the types of entities that you need to be making sure you bring to the table in your own community, right? Maybe it's anchor institutions like universities, healthcare networks, or other kind of major employers. And once you kind of get there, it's about saying, well, how do we then move collectively to think about what are the types of outcomes that we want to raise investment dollars around in the first place? And should we be thinking about this strategically to sort of align them in a way that when we go to market, it's not, hey, we want you to come do one really specific building. It's, hey, we've thought about sort of the evolution of our community. And this is how whatever this next investment is going to fit into that strategy. And then the second half of the playbook is a lot of the kind of technical deep dive into it, right? Because a lot of times when we met new projects early on in rural communities, they would say, hey, we have a great idea. We want to do a building. It'll be mixed use. We'll have apartments and something kind of on the bottom that will help our main street. And you would say, great, how much is it going to cost and what does the capital stack look like? And they would say, what's a capital stack? I don't know what that means, right? And so you'd have to get into it and say, look, these are the things that investors are going to ask for. And so we took a whole bunch of case studies. We have Opportunity Alabama featured in the playbook. We do stuff in Utah. We bring in Arctaris deals from across the country. So Arctaris is featured in the playbook, even though it's not an author. And I think it's something that we really want to make so that you could drop it into any community. And even if you take the word opportunity zone out of it, these apply to private capital investments all over underserved communities across the country. So it really is a powerful tool that we hope, kind of gives communities a baseline to start those types of conversations.
One of the things that I think was a criticism of maybe the regulations early on, but just of the opportunity zone opportunity generally, was that it wasn't necessarily always clear what the impact of these projects turned out to be, and there wasn't really a way to measure that and report it out. And I wonder whether you have a sense of what the kind of impact of the projects are. Who do they serve? What are the benefits?
So, I guess I will say first, we're big fans of the Transparency, Accountability, and Extension Act that is currently on the floor of the House and the Senate with Booker and Scott as co-sponsors. And I still have hope that there will be transparency and accountability behind opportunity zones.
And that's a sort of an extension and a streamlining of the regulations.
Precisely. This is the first. So the first piece of kind of, I think, genuine bipartisan legislation to amend this program really in the last 5 years since it came out is currently on the floor, right? And I think that piece alone, there's 4 or 5 different pieces of legislation, but that piece alone would be just critical for all of us that are practitioners in the field. All of us want to see it. I think all of us are just as desperate as Congress is to actually to prove this out. But So the anecdotes, because that's all we can give, right, is anecdotes, because we don't have hard data. The anecdotes I can give, again, going back to Selma. Look, I mean, Wood Forest National Bank, through their opportunity fund managed by CEI Bolos, invested in a $7 million hotel project right there, almost at the foot of the Edmund Pettus Bridge in Selma, Alabama, in a community that had not seen a $7 million project in a very, very, very long time. That single investment has now catalyzed the acquisition of several other properties along that same street right there at the foot of the Edmund Pettus Bridge, two of which are kind of currently positioned to actually start kind of moving forward into the full development cycle. So you're seeing all this in new investment activity happening in a place where you've got, it's rural, it's declining population, it's very much majority minority. So I mean, I think you're seeing some of the impacts of this program spill out. And interestingly enough, Selma is one of those communities where literally the opportunity zone goes right down the middle of the street. So of the things that are happening as follow-on investment to that OZ investment, half of them are happening in the OZ and the other half are not. But they're attracting capital from sources that are not OZ dependent, so it doesn't matter, right? And I think that's I know I'm now totally off the rails on the question you asked, but I can't stress this enough that the conversation that we're having is around place-based investment, right? It's around what does it take to facilitate investment off the coasts or from large national foundations, or even just from local folks, local corporations, local foundations. What does it take to pool the sources of capital and then deploy them to areas where there's need? And that conversation, Opportunity Zones is a part of that, but there's so many other facets of that conversation that if you've got all the stakeholders around the table, you can actually create even more flexible vehicles for deploying that capital.
If I could just add on to that, I mean, I think, short of these federal pieces of legislation that are going to come in, which we also really support and would love to see, I think going the next layer deep, we've really seen national and local philanthropy be the tool to really provide this incentive around the impact, going back to it, because if you have some sort of incentive coming in to even further de-risk whatever this deal is that money's being invested into, if there's strings attached with that incentive, hey, look, we'll give you a grant for this project, or we'll give you a guarantee, but we mandate that you have to be transparent about what you're doing and report your impact and showcase what's going on and be accountable to the community. That is a way to sort of hold some of these funds and firms accountable. And I think case in point, the Kresge Foundation and the Rockefeller Foundation early on got together and put some money in a first loss capital guarantee bucket and ran a competitive RFP at funds and said, look, this is going to go for funds that are willing to be transparent and willing to kind of report and be in line with the OZ kind of regs, because if you're not, we're really afraid that there will be some bad actors and they'll run with this. And I would say, fortunately enough for Arctaris, we were one of two firms that were selected for that guarantee, and it aligned with what we were doing anyways. But I mean, it's also kind of put our feet to the fire, if you will, that we're mandated that we have to report that, and it's in our impact report, which you can access online and kind of read through. We have to show what's going on and have to look at it, because otherwise, what happens is you only get the ones that the community sees are happening that are bad, and those take all the headlines, and you don't ever see the good ones that are out there. So we really want to see more transparency and see more accountability, because it helps kind of spread the word of there actually are good outcomes coming with this.
Are there still opportunities, so to speak, for new communities and new Opportunity Zone projects to get going and new Opportunity Zone funds? I know that there was a time limit on how the capital could be deployed. I think the legislation might extend that a little bit to give folks more time. But is this something that there's still sort of green rich, still running room ahead of us to get new projects and examples going?
I think so. Yeah, I mean, I'd be curious to get your thoughts on this.
Yeah. Oh, yeah. I think we think so very much. I mean, the timeline you're alluding to is when the original incentive was passed in early 2018. It put kind of two levels of incentive on the investors. You get an immediate deferment of your capital gains by investing into an OZ project. If you were to hold your investment for a minimum of 5 years, you could get essentially a 10% discount on that gain. If you held for 7, you'd get a 15% discount. But the latest you could extend that initial capital gain was 2026. So now that we're into 2022, we are 4 years, so you can no longer get those incentives. Your 10-year hold still is there. So whatever you invest in 2022, 2023, 2024, as long as you hold it for 10 years, you can exit your new gain with no taxes, but you're only deferring your initial gain up to 2026. And so one of the things they're talking about at the federal level is, can we extend that 2026 deadline so you can bring back some of those incentives on the step-up in basis? I think that if they are able to pass it, that would be a meaningful win for the sector and would lead to more dollars being invested. But even without it, we're currently raising our 7th fund at Arctaris, and we're having great success of folks who are still interested in it. It's not been a meaningful drop off from kind of where we were before. And I think we're seeing tons of projects. Actually, arguably, I would say from the project kind of creation level, we're far enough along in deals that have been done and regulations that are out there that there's more projects happening now than there was even in the early days of OZs. Because
Totally.
people feel much more comfortable doing it than they did in the early days.
Totally agree. And I think to your point about new fund managers, I mean, right, like we're a perfect example of this. We're only a fund 2, right? One day we'll be fund 7, but you know, when we think about our second fund off the heels of our $20 million first fund, I mean, so many of the LPs that have either already committed, already have dollars in, or that are thinking about commitments right now on the OZ side of the house, are people that wouldn't necessarily call themselves impact investors, right? In fact, probably wouldn't want to call themselves impact investors. I think they'd call themselves smart, rational investors who see an opportunity for some tax deferral and some really interesting tax advantages that probably would have never been in a conversation about what does local vesting look like, what does putting dollars back into the community look like. But when you start having this conversation about like, well, you're from here, right? You know, you can drive by this every day. You know, you're investing with a group of people who are going to be here for the next 10 years. And 10 years is such an interesting time horizon too in this program, because like at the end of the day, I mean, I think we all had high hopes for this program being an operating business investment tool. And your stat really 96%, right, has gone into real estate, right? The 4% into operating businesses, though, I will say, many of Alabama's best breweries are currently opportunity zone businesses. So that's a meaningful 4%, even if it's 4%. But long story short, when you think about 10 years and you think about 10 years as a real estate investment, right, you're thinking through at least one cycle, maybe 2. And so to have success in that model, to me anyway, you have to be really thoughtful about where is a community going to be 5, 6, 10 years from now. And you can't know that unless you're an Arctaris and you have deep connections with local, you know, boots on the ground individuals who are doing the work in the communities and you're investing through them. Or if you're us and you've got literally someone you can call in every single one of the 67 counties in Alabama and understand where that's headed. So for me, I actually think that OZ investing, given the 10-year hold, is still at play, right? And given the 10-year hold is really what people are thinking about, I actually think it sets up really well for continuing to raise capital from impact agnostic folks. And if you've got the right kinds of managers bringing that impact agnostic capital into the impact space, in a strategy that I think kind of makes sense both from a returns perspective, because it just makes sense to invest in places where you've got a deep tie to the community and you can see a 10-year growth trajectory, and from a impact sense for all the same reasons we just talked about. So I think it actually sets up well, at least until 2026, to continue to keep capital moving.
Well, that sets up, I think, what my last question is, and I'll give you each a chance to answer, which is look out 10 years. And now the Opportunity Zone, assume it hasn't been extended or renewed, but now we're into just regular old investing. And what does Alabama look like, and what does Utah look like in that context?
Phenomenally interesting. Hopefully we'll be on Fund 7 by then. But
Fund 12.
Fund 12, right? So I think for us, it looks like a complete integrated impact investment ecosystem on a statewide basis that's mobilizing multiple sources of capital for multiple kinds of investors, finding kind of the right rates of return for each of those investment groups and placing them into vehicles. Again, it's the traditional kind of blended fund that Arctaris does so well and that many others in the impact community do so well, right? But it's place focused. So for us, I mean, look, we've already put $20 million to work in $400 million worth of projects. We're raising 40 this time around, and we'll probably put that to work in $600 million worth of projects. So, I mean, I see us, very much continuing to kind of build on that local vesting ecosystem. And ultimately, I think having maybe, I don't know if this is nationally unique or not, but it's certainly unique regionally, an ecosystem where you've got community engaging with minority investors. Vast majority of the LPs in Fund 2 that are individual LPs are going to be Black and brown, a lot of them first-time investors, right? And folks with capital gains who totally span the gamut from someone that sold a paving company to someone that just sold a whole bunch of Amazon stock, right? That kind of an investor milieu, bringing them together around a particular geography, around a series of particular geographies, I don't know what's going to come of that. But I can only think that it's going to be good because, it's if it continues on the same trend that we've continued on. We can edit this, right? Yes. Okay. God, I rambled like hell on that one because I had no idea where I was going. Let's chop that down a lot when we edit it.
If you want to do it again more succinctly, that's fine.
It's fine. You can just cut the answer.
I think we should keep all this in. I thought it was good.
I thought it was fine.
Go
Go
ahead.
ahead.
No, I would say in Utah, what I would hope we'd see is sort of two things. One would be this concept of regionalism within the state. So far, it's sort of been this urban versus rural divide, and it's been so binary that there's sort of this fight to the bottom in terms of getting resources. And when you get 4 urbanized counties and 25 rural counties, and there's no regionalism going on, you have all of these counties kind of stepping up and saying, well, what about my development? What about this? And no one's thinking about the picture regionally for what does this part of the state need? And maybe that's a 5-county cluster. And what does this part of the state need? And so more collaboration around that to kind of move into new sectors. We previously have had a lot of coal-reliant communities that have been heavy producers of coal energy that are trying to move in to be sources of renewables. They still want to be an energy hub for the state, but they recognize they've got to move into kind of new business models. But they'll only do that if they're able to work together. If one tries to compete against the rest, none will win. And I think the other component is pre-COVID, this concept of kind of public-private partnerships, and you could even add in a third P, which is philanthropy. Everybody said, yeah, that's nice to have. I'd love to put money into deals that helps de-risk it, but it seems really complicated. With the unprecedented amount of capital now flowing in from the federal government and philanthropy playing a role, I think to support that regionalism, you see a ton of public-private partnerships in how those funds are done. And you don't see this dynamic that we've seen historically, which is you have philanthropy in one bucket, you have public capital in another, and you have private investors. They all have to work together. But all 3 of those groups still speak very much a different language. So my hope would be in 10 years that there's at least a framework to kind of better that to support those outcomes. And that's one example in one state. I think you could easily remove Utah in some of those examples, and that probably applies to all 50 states. But I think that's a big piece of what I would hope we'd see if we could kind of jump in the DeLorean and go to 2032.
So vibrant local ecosystems, bringing capital to underserved areas, rural and urban, and producing real impact, sparked by opportunity zones. Thank you, Alex, and thank you, Patrick.